Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if this company is adding up the numbers or adding up to trouble. This particular filing is a registration statement for an investment fund, which means we are looking at how they plan to offer their shares to the public and what the juicy details are around their investments and risks. Before we dive in, if you love getting the real story behind these corporate filings, hit that subscribe button and ring the bell so you never miss an episode. Join our Discord community, linked in the description below to keep the conversation going. Alright, let's decode this. This is a filing from the Accordant ODCE Index Fund, and they are essentially telling us here is how we are going to sell you our shares. And here is everything you need to know about where your money is going and what could go wrong. They are trying to track a big real estate index and they offer different classes of shares. So think of it like buying into a real estate investment, but through a fund structure, and there is a lot to get through here. Think of this as the official document that says, hey SEC, we want to sell these shares to the public, and we have laid out all the facts, and of course any registration statement like this comes packed with a risk section. This fund is investing in real estate, and we all know real estate can be tricky. This part is super important because it lays out the potential problems with how this fund operates. For instance, they talk about the fact that the fund relies heavily on its investment advisors, Accordant Investments LLC and EDR Investment Management LLC. If these advisors stumble, or even if they just get too busy with other clients, it could hurt the fund. This is a pretty common risk with managed funds, but here it is laid out clearly. This is a big red flag for me. The advisor Accordant Investments was only established in 2023, so they don't have a long track record to look at. That means they are largely unproven. This is a huge risk for investors because you are trusting your money to a new company. And here it is in black and white. They are telling you directly that you could lose a lot of your money. This is pretty standard language for any investment, but given the fund invests in real estate, which can be volatile, it carries extra weight. Now for the numbers, this section gives us a snapshot of the fund's performance per S-Hair over several years for Class I shares in the year ending the 30th of June 2025. The net asset value per S-Hair started at $9.36 and ended at $9.21. That is a slight decrease of about 15 cents. Per share for the year, so not a huge gain there. This is where fees come into play for Class I shares. The total annual fund operating expenses, after fee waivers and reimbursements, is 1.11%. That might not sound like much, but remember these fees eat into your returns, especially over a long time. For Class I shares during the year ending the 30th of June 2025, the total return was a positive 2.43%. That is modest. But at least it was positive the year before, though. It was a negative 9.73%. Clearly this fund can be volatile. Now let's look at Class of shares. These shares come with a sales load, meaning you pay a fee up front, and for the year ending the 30th of June 25, the total return was 2.21%, which is similar to Class I, but remember that initial sales charge can really impact your early returns. The management fee is 0.60%. That means for every $100 invested, 60 cents goes to the managers. This is charged annually and it adds up over time. The fund states it will invest the net proceeds from selling its shares as soon as practicable, which usually means within 3 months, but they can take longer if needed during that waiting period. Your money might be in temporary investments like short-term government securities. The main goal here is to track the NFI ODCE index, which is a big real estate index. They do this by investing at least 80% of their assets in what they call eligible component funds, which are real estate investment vehicles that make up this index. So basically they are trying to mirror the performance of a large basket of real estate investments. This is a key point. The fund says they might use leverage, which is borrowing money to invest. This can amplify gains, but also amplify losses. They mention they have a credit facility for $2.0 million. This is a way they can borrow money to manage cash flow or meet repurchase requests, but it also increases risk. This table illustrates the impact of leverage if the portfolio return is negative 10%. The share total return drops to negative 10.73%. That extra 0.73% is the amplified loss due to leverage. Conversely, if the portfolio returns 10%, the share return jumps to 10.13%. It shows how leverage can work both for and against you. This section is crucial. It means that as a registered closed-end management investment company, there are rules to follow about raising money and how they do it. These rules can present risks. This is also a big one. It means the fund has to be very careful about dealing with related companies to avoid any funny business, and they need official permission from the SEC for many of these deals. This adds complexity and potential delays. This fund has elected to be taxed as a REIT or real estate investment trust to qualify as a REIT. There are very strict rules about income and assets. If they fail to meet these rules, they could be taxed as a regular corporation, which would be a major problem for shareholders. This statement is stark. If they lose their REIT status, they will face significant tax consequences. This means less money for distributions and higher taxes for the fund itself, which ultimately affects your returns. As of September 2025, no single shareholder owned more than 25% of the shares. This means no one person has complete control, which can be good for diversified ownership. Looking at the number of shareholders, Class I has 187 shareholders, Class A has just 1, and Class Y has 5. This shows Class Y shares are for very large investors, probably institutional buyers, and Class A is for regular folks, while Class I fits somewhere in between. This distribution tells you who they are targeting. Now for my take on this filing, Accordant ODCE index fund is trying to provide access to real estate investments through an index approach. They are structured as an interval fund, meaning liquidity is limited to quarterly repurchase offers. But a major red flag is the newness of their advisor, Accordant Investments, which was established in 2023. That means a lack of a proven track record, especially when they mention it directly in the risks. The fund does invest in real estate related vehicles and has an objective to track a specific index, but the complexity of real estate investments and the layers of fees inherent in funds of funds, including the underlying fund expenses, can significantly impact returns. The REIT status they aim for is a positive for tax efficiency, but the risk of failing to maintain it is a serious concern. The financial highlights show modest returns with some volatility, and the leverage they might employ adds another layer of risk. While the fund offers diversification into real estate, its success hinges heavily on the performance of the underlying real estate investments and the adeptness of its relatively new advisors. Overall, this fund is for ors who understand the risks of real estate, understand the limitations of interval funds, and can tolerate the added risk of investing with a new management team. The numbers we saw are not spectacular, and the fee structure combined with potential leverage means you need to be very cautious and do your homework. What are your thoughts on this type of real estate fund and the risks involved? Let us know in the comments below. If you found this deep dive valuable, give this video a thumbs up and subscribe for more corporate breakdowns. Don't forget to join our Discord community for ongoing discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.